Hey everyone, on this channel we break down complex financial topics into easy to understand advice. Today we're tackling a question that puzzles many investors, especially beginners. How often should you actually check your investments? Are you obsessively checking your portfolio every single day, or have you completely forgotten it exists? The truth is, the right answer probably lies somewhere in the middle, and it might be less often than you think. Stick around because we're going to dive into the pros and cons of different checking frequencies and help you find your personal sweet spot. Let's start with the pitfalls of overchecking. I get it. It is exciting to see those numbers fluctuate, especially when they're going up. But constant monitoring like daily or even weekly checks can actually be detrimental to your long-term success. Why? Because the market is noisy. There are daily ups and downs that are completely normal and don't reflect the health of your long-term strategy. Constantly looking at these short-term fluctuations can lead to emotional decision-making. You might panic sell during a minor dip or get overly enthusiastic and take on too much risk during a surge. This is often referred to as watching the paint dry suey. It feels like something should be happening, but for long-term growth, patience is key. Studies even show that investors who check their portfolios less frequently tend to perform better because they're less likely to react impulsively to market noise. Now, on the flip side, what about underchecking? Is it okay to just invest and forget about it for years? While a hands-off approach is generally good, completely ignoring your investments for a very long time also has its risks. You might miss opportunities to rebalance your portfolio, which is crucial for maintaining your desired risk level. For example, if your stocks have performed exceptionally well, they might now represent a much larger portion of your portfolio than you originally intended, making it riskier. You also wouldn't notice if a particular investment fund changes its strategy, or if your personal life circumstances, like a new job, marriage, or kids, require an adjustment to your financial plan. So, what is the sweet spot for most long-term investors, whether you are building wealth for retirement or a down payment on a house in 5 to 10 years? A quarterly or annual checkup is usually sufficient. This allows you to step back from the daily noise and review your portfolio from a broader perspective. During these quarterly or annual check-ins, here is what you should be doing. First, review your asset allocation. Are you still at your target percentages for stocks, bonds, and other assets? If not, it might be time to rebalance. This means selling a little of what has performed well and buying a little more of what has lagged, bringing your portfolio back to your original target. This is a disciplined way to sell high and buy low. Second, consider your personal circumstances. Have there been any major life changes? Did you get a raise? Have a child? Are you nearing retirement? Any of these events could mean you need to adjust your contribution amounts, your risk tolerance, or even your investment goals. Third, ensure your investments are still aligned with your original strategy. For example, if you are invested in index funds, are they still tracking the index as you intended? If you own individual stocks, have the company's fundamentals changed significantly? Keep in mind that daily checks are for very active traders, not for typical investors focusing on long-term growth. If you're checking every day, you're likely overdoing it and potentially harming your returns. What is your current routine for checking your investments? Do you check daily, weekly, monthly, or less often? Let me know in the comments below. I'd love to hear your approach. So the takeaway here is less is often more. For most of us, a quarterly or annual checkup is perfectly sufficient to ensure our investments are on track without falling prey to emotional decision making. It's about being strategic, not reactive. If you found this video helpful, give it a thumbs up and subscribe for more financial tips. And remember, smart investing isn't about constant monitoring. It is about a well thought out strategy and consistent action. Thanks for watching, and I'll see you in the next video.